Welcome to our video on recontribution strategies. My name is Yianni. I'm a financial planner and principal at OzPlan Financial Services Mitcham. Big disclaimer here, the information we're covering today is general only and should not be taken as financial advice. Please seek professional assistance before enacting on any information you read or see on the internet. We do not know you personally, nor are we suggesting that you should be doing these strategies. So what is a recontribution strategy? Essentially, a recontribution strategy is referring to the process of withdrawing and adding money back into your superannuation with the sole intention of essentially reducing the taxable component of your super fund and increasing the tax-free component. And we'll talk about what these taxable components and tax-free components mean. But in essence, what we're trying to do is we're trying to protect or preserve your estate's value. So essentially what happens on death, if, for example, your superannuation benefits are being paid to a non-financial dependent or a non-dependent, essentially the ATO can retain up to 17% of your taxable component in super. So it can be a significant amount of tax that you'd be paying on death, especially and only when the money is being paid to a non-dependent, so not to a spouse, to a non-dependent. And that's what this strategy is trying to address. There are two types of contribution sort of components. There's tax-free components and taxable components. So we'll start off with the taxable superannuation components. The taxable components are essentially made up of prior concessional contributions such as super guarantees or any salary sacrifice contributions or personal contributions. On top of that, you've also got the accumulated investment returns on your savings in super. So what this means is essentially if you've claimed a tax deduction, it's falling under the taxable taxed component. There's also potential untaxed elements within super funds, but these are generally under those government sort of, military schemes, which are a lot less common. But the vast majority of Australians who would have an industry super fund would be having a taxable taxed element as part of their member balance. Moving on, we've also got tax-free components. So these are generally made up of contributions where you haven't claimed a tax deduction on. So think of essentially non-concessional contributions. They're the contributions where you have that 120,000 annual cap and 360,000 cap over a 3-year period, known as the bring forward. Okay, so what happens is the taxable tax component on death, if it goes to a non-dependent beneficiary, 17% tax including Medicare levy. The tax-free component goes tax-free, as the name suggests. So there's no tax payable on the tax-free component on death. So the benefits of completing this recontribution strategy is essentially to preserve your estate. So we're wanting to preserve the estate so that as much of your hard-earned money goes on to those who you intend on passing on your wealth to. That's the bottom line. How it works is essentially we've got a client. They've got money in super, they've got a personal bank account. We take money out of super, for example speaking, we might take out 120,000 this financial year. That money goes to the client's bank account, and in that same financial year, that client recontributes that 120,000 back into super as a non-concessional contribution, essentially taking money out that's potentially taxable and putting it back in as tax-free monies. That process is the recontribution strategy, and that's essentially how it works. We're taking money out, we're putting it back in. Now, when the money comes out, it retains the taxable and tax-free proportion. So, for example, if let's just say the 120,000, 80% of that is taxable components. Then, when you take the money out, 80% of that is taxable and the 20% is tax-free. When you put it back in, however, 100% of your contribution is tax-free. So you can't pick and choose where you want your withdrawal to come from. You can't say, I want all the money to come from the taxable component. Essentially, you've got to take it out and it remains within those proportions as stated by your super fund or the ATO. Now, there are a few important considerations. First is your eligibility. So depending on how much you have in super, you might be breaching or exceeding the total super balance required, which means you might have trouble getting money back in. There could be your age, which could be a factor, so restrictions on contributions or restrictions on withdrawals. Essentially, also you've got annual and caps that apply, so any non-concessional contributions which exceed the caps essentially would result in excess tax payable and penalty interest. So to be able to contribute, you essentially have to have available cap space. You can find that out through your MyGov ATO portal. Now, in terms of the tax implications, you could pay tax if, for example, speaking, you're withdrawing money under a certain age. And what we would be doing as financial planners is essentially reviewing that and making you aware of if there's any tax payable or not by making those withdrawals. Now, I did mention the bring forward arrangement, which is essentially allowing you to contribute up to $360,000 in a given financial year. But what this then restricts you in is essentially the following 2 financial years after that, you are unable to make additional non-concessional contributions. Essentially, you cap out. So it's essentially you're bringing 3 years worth of contributions. So 3 years worth of 120,000 contributions in 1 year. That's the bring forward arrangement. And we would typically use this strategy or contribution type for those who may have relatively smaller balances in super, and we can essentially complete this recontribution strategy in one go. So that's where it's powerful, and it's also powerful for those who may have high balances where we're trying to reduce the amount of taxable component in a shorter period of time. So they may be age restricted, so in a few years' time we might have age restrictions that we've got to sort of compete with. So making potential contributions using the bring forward arrangement could be a lot more enticing for us. The timing of the strategy is also something that we take into consideration. So what we do is essentially we look at what financial year we're in, how far into the financial year we are, and your age and total super balance and all other sort of areas which may restrict our ability to get money in and out. So what we do is we use a blend of bring forward contributions and or, for example, the allowable 120,000 non-concessional contributions, just to ensure that we're getting as much in as possible and we're maximizing this recontribution strategy with the time that we have available. So let's look at a working example here. We've got a super fund that has a balance of $360,000. That's broken into 2 different components. You got your taxable component and you got your tax-free component. So the taxable component in this example is made up of about $225,000, the remaining balance in the tax-free component. Now, in the event that there's a non-financial dependent that's nominated as a beneficiary or is going to be in receipt of the monies, the taxable component would be subject to that 17% tax on death. That's your death tax, which equates to about $38,000 in death tax. Now, what we're going to do as part of this strategy is we're taking out the 360 in full and we're recontributing the 360,000 back in. Okay, so when we're putting the money back in, because it's classified as a non-concessional contribution, 100% of our new contribution forms part of that tax-free component, as you can see there. So essentially there's no monies in the taxable component, which then has resulted in that massive tax saving to our client of $38,000. Now, of course, the client won't see this benefit whilst they're alive, but their beneficiary certainly would. Now, it's really important you seek professional advice in this area. It's highly complex. There are many moving cogs, and you just don't want to get it wrong, because if you do get it wrong, there are certainly financial consequences that you must bear. So a financial planner can definitely provide that appropriate guidance and assistance along with your accountant. So essentially we'd be working as a team with your accountant to ensure that the appropriate strategies put in place and that we're remaining within your allowable caps as per the ATO rulings. Thank you for sticking around. If you've got any questions, always feel free to call our office. Always happy to help, and see you in the next video. Thank you.